Welcome to the Teaminvest Wealth Builders podcast, where we bring you insights, strategies, and stories to help you build and compound your wealth and knowledge. I'm Kerry Fleming, your host for this exciting series. Whether you're a seasoned investor or just starting your wealth building journey, this podcast is designed to inspire, educate, and empower you. Let's get started. This week, we have a bonus short episode with Tip Group CEO Andrew Coleman on the importance of looking at moats when considering businesses for investment. What is a moat, I hear you say? Well, let's find out.
At Teaminvest, we talk a lot about moats and why they are such an integral part in making a good investment. So we should probably spend a little time talking about what a moat is and why they matter. A moat, very simply, is a factor of a business, something innate to the way that organization is run that gives it a barrier to entry against competitors, a barrier for someone else to eat their lunch, or an ability for that company to remain a price maker and deliver a sustainable competitive advantage. If you think about the old medieval analogy of a castle with a wide moat around it, protected by tall walls and turrets, that's what we're talking about here. What is it that protects a business from a competitor eating its lunch? So why does it matter? It matters very simply because any business that makes reasonable profits, particularly outsized profits, will by definition attract competitors. If your competitors see that something you do is earning you an outsized return on equity or more money than them, they will seek to copy it. And so any competitive advantage will only remain a competitive advantage for so long as you can protect it. Of course, moats come in all shapes and sizes. They can be very narrow and not very hard to cross, or wide and deep and infested with crocodiles, or for those who prefer Mike Myers, perhaps sharks with laser beams strapped to their heads. The key for any business, though, is to do two things. One, to develop their moats, but the second, and often most forgotten, to continue to deepen and widen them. Because just having a moat isn't enough. In fact, having a moat often tells your competitors, here is something worth attacking. So at Teaminvest and at Tip, whether we're advising a customer around how they can build strong and lasting moats, or looking at an investment and determining whether a business has strong and lasting moats, we need to ask three questions. The first is there a moat at all? And the easiest way to tell that is to look at the return on equity generated by the asset. If that return on equity is materially higher than its peers, that's evident that there's a moat in place. If the return on equity is equal to its peers or lower, that's probably evidence that the moat isn't there or needs a lot of work. The second thing we do after identifying if a company has a moat is to ask, how deep and wide is the moat? Is this moat something that adds a significant barrier to entry or sustainable competitive advantage, or is it only transitory, providing a small increase, say 1 or 2% of return on equity, compared to maybe 10 or 20% higher than its peers? And then thirdly, we ask, what is the durability of that moat? Of course, a wide moat is valuable, but it's much more valuable if it's going to last a long time than a wide moat that could be crossed in days or weeks with investment from a competitor. Now, why does that matter to you? Well, simply put, whether you're running a business or making an investment, you want to be in your best position possible so that you can go away to a desert island, for example, or just a lovely holiday, and know that the business that you return to or the asset you've invested in will continue to generate the returns you want without you needing to be there watching it like a hawk. And the only way a business can do that is with deep and lasting moats. So we keep using the term moats, and we keep talking about sustainable competitive advantages or barriers to entry. But the obvious question, of course, are, can you name some examples? So some obvious examples of moats are things like intellectual property and patents, a legislative reason why that company has an edge in a certain product or service that its competitors cannot breach, at least not without a significant investment in either working around that patent or reinventing it. Another example of a moat is having some form of production or technological advantage that enables you to produce the good at a substantial discount to your competitors. Perhaps that is, for example, owning an asset, for example, a mining tenement located very close to a port or near close infrastructure, which gives a long-term cost advantage. Those moats tend to be a bit weaker, but they are still very valuable. Another kind of moat is the moat that we at Teaminvest call the trapdoor moat. That's a moat where to switch away from your product or service is not impossible, but incredibly costly. Think something like a spinal transplant, where you're already plugged into using that software or service so deeply within your organization or personal need that to switch to save a few dollars is just not worth the effort. Accounting packages have historically had this, although with more recent technological advantages, may be losing their trapdoor moat. Another moat is in relation to what you can do for your competitors, getting them faster or better service. And in fact, those moats tend to be the strongest, although they can always be breached. A good example for that is, for example, something like Netflix, which I'm sure many of you use. Netflix's advantage around the ability to originally compress and stream data gave themselves such an edge over their competitors that they were able to redefine the genre, although that moat over time has clearly weakened as other competitors have worked out how they too can stream high-definition video. All of these are just simply examples, and I'm sure you can find more, both in your own businesses and in the portfolio of assets you own. The key thing to do, of course, is to regularly reassess how deep is that moat, how wide is that moat, and is it still as durable as it was when you first created it? Nothing lasts forever unless you put the effort in, and a moat is no different to anything else in business in that way. Ideally, in a perfect world, you would like to invest only in assets whose moats are so strong that competitors are so discouraged they don't even try to attack it. However, in reality, it's probably unlikely, and you're much better off just looking for businesses or assets whose moats are wide and raging like the Mississippi, rather than a bunch of small streams that can be crossed in very small steps.
Thank you for joining us on this episode of Teaminvest Wealth Builders. We hope you found today's discussion insightful and inspiring. If you know anyone else who could benefit from hearing this episode, please hit the share button and pass it on. If you'd like to learn more about Teaminvest or our unique investment approach, visit us at teaminvest.com.au. And please don't forget to subscribe to the podcast for more episodes. Until next time, stay informed, stay invested, and keep building wealth.